So what we're going to do today is inventory and stock accounts, because in accounting, for our accounting records, we do not draw up an inventory account or one inventory account. We actually have 4 inventory accounts that are basically named after the transaction. So we can only sell inventory, purchase inventory, return inventory, or have inventory returned to us, the business. So those are the 4 accounts. We have our sales account, which is inventory sold, whether it be for cash or credit. Now remember, we are not talking about journals. The sales journal is just for credit sales of inventory. We are talking about the account or the T account, and therefore the T account, all sales of inventory goes into that T account. Okay, so your sales account, your purchases account, which is inventory purchased, whether it be they purchased it for cash or credit, once again. Returns inwards account, also known as your sales returns account. And your returns outwards, also known as your purchases returns account. Right, so these are your 4 accounts that represent inventory. They are for inventory only. So if it is that you sell furniture or any other non-current asset, that does not go into your sales account. That will actually go into the non-current asset account, okay? So just remember, your sales, purchases, return in, return out, these accounts are for inventory only. These are your 4 accounts representing inventory. So what are the double entry rules for inventory? Remember, double entry, when you debit, when you credit. So basically what we have there is account, which would be our sales, purchases, returns in, return out. Remember, category. We use category to know whether or not we debit or we credit. So for sales, even though inventory is an asset account, when we break it up into the 4 types, we are not going to look at it just as assets. We are actually going to look at it in terms of income and expenditure or expenses. So sales, whenever you sell something, it is income that is earned. Yes, in fact, sales is the business's main source of income. When you start a business, you have an objective, and that is to generate income or revenue. How do you do that? Are you going to sell clothes, shoes, stationery? You're going to sell something or provide a service, but we are dealing with the selling of goods, not the provision of services. So you're going to have to sell inventory. That is how you're going to earn most of your revenue. Yes, there's other ways of earning revenue, but that is not your main objective for your business. When you set up your business, it is to sell something specific, right? A cafeteria, it will be foods and drinks. Stationery store will be all sorts of stationery. A car dealership would be the motor vehicles. Furniture store will be the furniture. But whatever it is, it's your inventory that you are selling. And why are you selling it? To earn revenue or income. So any sales of inventory is income. Purchases is the opposite of sales. So purchases, you are spending money. It's expenditure. So it is considered an expense. And then return inwards, how you look at it is, yes, you can look at it that you have more assets coming in because they've returned the inventory. But remember what return inwards is. Another word for it is sales returns. It is like you have sold goods, so you've gotten income, but then they return the goods to you, which means you kind of have to give them back the income. Means you have to spend money or give them back money. So that is why it's considered an expense. You can just remember it. It's the opposite of sales. Sales is income. Sales returns will therefore be expense. And the same thing for returns outwards, also known as purchases returns. It is like you have spent money, expenditure, expense in the form of purchases, but then you return the goods for whatever reason, which means you're kind of getting back your income, right? So it is considered income, or you look at it as the opposite of purchases because it is purchases returns. So having said that, we have identified the category. What I always suggest you do to know whether you debit or you credit is to have your little note there. Your little note in terms of Alice stating what you do when you increase, and you can also write what you do when you decrease, or you can just know it's the opposite. It's the opposite of what you do when you increase. So when you decrease is the opposite of what you do when you increase. So we are on income for sales, income, credit. If you don't do this, as what happened in class previously and stuff, it's very normal to happen because we think that income is the good one, right? So we think that assets are good, income is good, so they are both debited. That is not the case. As you would see when you list the rules, income, credit. Expenses, we consider it bad. So we tend to want to think mentally, psychologically. One time we think expenses are credited. Not so. In fact, assets and expenses go together. They are both debited. Reason being is that we cannot use our assets unless we pay our expenses. So when you look at it that way, expenses are very necessary and therefore a good thing because they allow us to be able to use our assets. For example, motor vehicle is an asset. We can only use it if we pay for gas and we pay for insurance and we pay for repairs and maintenance. So it is necessary to pay the expenses to get the benefits of our assets. Electricity, an expense, the amount of assets that you can use when you have electricity. So when you pay your electricity bill, don't test it and not pay electricity. See what happens. You guys will know whenever electricity goes, amount of things that you can't use and you're frustrated. So expenses go with assets. We need the expenses, they are necessary. So assets and expenses debit, right? They are the ones that go hand in hand. Income is a credit. You're earning income, it's a credit. Okay, so expenses debit, income credit. So that means sales would be a credit, purchases a debit, return inwards a debit, return outwards a credit. And that is what we need to know. The decrease is only used at the end of the year when we are going to transfer to income statement, which we are not even close to doing right now. You're totally going to ignore the decrease and you're going to focus on the increase, okay? This is what you do when there's a sales, credit, purchases, debit, return inwards, debit, returns outwards, credit, okay? And then when we go further and we do the income statement then, but this is what you're learning off, please learn it off. So whenever you see, that is what you will do, okay? So the next topic that we're going to do is capital account and drawings account. Now there are rules, we call them the concepts and stuff. So rules in accounting that determine what we do, how we record our information. And we didn't do it, even though it's early up on the syllabus. We have not done it as yet, but you would see some of these rules, you will be exposed or introduced to them as we do certain topics. So that is how we are choosing to do it. And then as you get more confident with the accounts, then we will come back and we will go into more detail in terms of these rules. But the first rule that I'm officially going to introduce you to is called the separate entity concept, also known as your business entity concept. which basically states that the owner's private transactions are to be kept separate from the business transactions. So only business transactions are recorded in the business books. So we are not going to record the owner's private business unless it affects the business directly. Okay, so whenever the owner invests in the business, that is a business transaction. We look at the owner as totally separate from the business for accounting reasons and accounting reasons only. Because in POB, you would have learned that they are both the same, right? You would have learned that the owner and the business are one and the same. If you're suing one, you're suing the other one. That is what you would have learned. But this rule states that for accounting purposes, we treat the owner separate from the business for accounting purposes, which means that whatever the owner does privately is not our concern. It's not our business. Got it? It's not our concern. We do not record it unless it affects the business directly. So there are two accounts that are open to record when the owner does a transaction with the business. So the owner basically can do two transactions with the business: invest or take out, right? Remember, we're treating it as separately, owner, business. So the owner can either put in or contribute to the business or take out of the business, okay? So capital, which we have already been introduced to, is any asset contributed or invested by the owner for business use to operate and generate revenue. So we have already done that. Many times you've seen the owner has invested, owner invested, and you know now that is capital. So we have to record in a capital account because it is separate. The owner separate, so he is investing. So we have to record that he is investing in the business, which is separate from him, okay? What we are now going to be introduced to is when the owner takes out for personal or private use. So the opposite of the investing. So whenever the owner invests, that is capital. Whenever the owner takes out an asset from the business for his own personal or private use, that has to be recorded as what we call drawings. So drawings is any asset taken or withdrawn from the business by the owner for personal or private use. Remember, we are keeping private business from business, right? They are different. So the owner's private life, private personal life, whatever he does in terms of transactions is kept separately or treated separately from the business transactions. If he takes out an asset from the business for his own personal use, we have to record it because the business is affected. The owner has done a transaction with the business, even though he is the owner. So you might say, well, he's taking it, but it's his. Remember, we are treating it separately, right? So even though it is his in reality, for accounting reasons, we have to treat it, he has taken out of the business, right? As a separate entity. Okay, so in this case, let's use an example. The owner has invested a car in the business, meaning that the owner would have taken his own personal or private car and decided to contribute it to the business for business use. So he is now going to use it for business purposes. Remember, once again, treating private separate from business. So because he has now taken his private assets and contributed it to the business, that means it is now going to be recorded as capital. So you see, that is capital whenever an investment of any asset, cash, bank, any asset, in this case, a motor vehicle, capital. But what if the owner were to take back that motor vehicle, that car? He decides that, well, the business is not doesn't need it, or he needs it more for his private business. So he is going to buy another car, or purchase a car for the business. So he takes back his car to be used again for his own private business. That means that the business has just lost an asset, right? It's no longer going to be used for business use. So that means that is a decrease in the capital, which we call drawings. So you see how it's a decrease in capital. Capital is an increase in capital because you put N. Drawings would be a decrease in capital because you've taken the asset out of the business. Totally out, right? Totally out of the business. So those are our two accounts, the capital and the drawings. And well, we are already, what are the double entry rules? We are already familiar with capital. So capital is capital in terms of Alice. And what we do whenever capital increases, which is an investment, we credit. What do we do when it decreases? We debit. Now remember, drawings is a decrease in capital. So which means in reality, what we are supposed to do every time the owner withdraws or makes drawings of any asset, we are supposed to go to the capital account and put it on the debit side. So put that information for that drawings on the debit side. However, for accounting purposes, we prefer to keep the investments, which is the capital, separate from any drawings. Capital, you don't see any decreases. The only thing you see would be the increases. And then, therefore, what we will do is we will have a separate account for the decreases, which is your drawings. So if you're understanding, we have two separate accounts. We prefer to have two separate accounts. One that shows your capital, which is your increases, your investments, and the other one that shows your decreases, which would be drawings. So we totally get rid of the debit side for your capital account. We create a new account called drawings, and that account, you will still go on the debit side because drawings is a decrease in capital. So drawings is a decrease in capital, therefore you're going to put it on the debit side. So when it's invested, capital account credited. When you have drawings, drawings account debited. Here's an extremely easy way to remember it. Capital C credit, drawings D debit. So coincidentally, we have the same letter for each one. How wonderful. So once again, C, capital credit, D, drawings debit. Okay, so that is how you can remember it. Nice and easy, good suggestion. So in terms of your notes, how you can put it, we are required to open two separate accounts for increases and decreases in capital. So for the increase in capital, it will be your capital account credit. For your decrease in capital, it will be your drawings account debit. So you can pause the video and you can just jot this down if you haven't already. So there it is again, and continuing with our notes. Remember, we did an activity and we had not introduced this as yet. So we are going to use number 6 from that activity to illustrate the point. All right, so you see that the owner withdrew for personal use. Once you see personal use, private use, or it's implied, you know one time it's drawings. Very nice and easy. As soon as you see personal or private, or it's implied, drawings. So a decrease in capital, which is called drawings. You're withdrawing capital, you're decreasing capital. What is that called? Drawings. So you name of your account, drawings. Which category is that? It's capital. Did capital increase or decrease? It decreased. So therefore, what do you do when capital decreases? When it increases, you credit. So when it decreases, it will be debit. Or just learn it off, as we have said before. Every time there is drawings, there will be a decrease in capital, so it will be debited. Drawings, debit. Drawings, debit, D, debit, D, drawings. Every single time. And then the next account, just to finish the transaction, would be bank. And since it's bank account is an asset, you withdrew from the bank, right? So you had money in the bank, money that could have been from a form of a loan, from income earned from the owner himself when he invested. So you have money in the bank, but then the owner comes and takes out that money for his own personal use. It still means that you're decreasing the amount in the bank account. So it will be a decrease. And what do you do when an asset decreases? You credit. And you will see that you have your debit, credit, your debit, and your credit. Good. So as we said, whenever the owner withdraws any asset for personal or private use, the drawings account is debited. So every single time you identify that it is drawings, you're going to debit the drawings account. But what about the other part of the double entry? The asset that is withdrawn, example, whether the owner withdraws cash or money from the bank account or inventory, that account is credited to show that it has been withdrawn, the business, it has decreased. So it has gone out or been withdrawn out of the business by the owner. That is what drawings is. So for example, if the owner withdraws cash for personal use, as we said, every time there is drawing, personal use, you debit drawings account. The cash is the asset that has been withdrawn and therefore has decreased. So therefore, the cash, which is an asset, decreased. What do you do to an asset when it decreases? You credit. So you credit the cash account, as we said there, and you're going to see it as we do more examples. The asset that is withdrawn, you credit it. So what if the owner withdraws money from the bank account? So he takes the money out of the bank account for personal use. Drawings, so you debit the drawings account. And as we said, the asset is credited. And what is the asset in this case? The bank account. So you will credit the bank account as an asset that has decreased. All right, so there's one more asset that can be withdrawn from the business by the owner for personal use, and that would be inventory. So if the owner withdraws inventory for personal use, once again, you debit drawings. But which inventory account will you credit? Because the asset is inventory, but remember what we learned earlier. We learned earlier that inventory has 4 accounts: sales, purchases, returns in, returns out, or sales returns, purchases returns. Which one of those 4 accounts will best describe the transaction, which is that the owner has taken inventory out of the business? Some of you may be tempted to say sales, but has sales actually occurred? Have we earned any income from sales? No, the owner took it out of the business for his own personal use. He did not pay for it. So there is no income earned in that case. So it's not sales. Has any goods been returned, or have we returned any goods? Once again, the answer is no. So process of elimination, it would be purchases. And the explanation, drawings of inventory is recorded as a decrease in purchases of inventory. Why purchases? we purchase inventory for resale. If the owner takes from those purchases, that means he has decreased the amount of inventory that we purchased for resale. So it is therefore a decrease in purchases. There we go. And if we were to put it as purchases is the expenses, as we learned earlier, purchases, expenses, it will still be a decrease in the expenses, and expenses are decreased by the same credit. So you see that? It is the same answer that you will get. So every single time you have drawings of any asset, you will debit the drawings account and you will credit the asset. If the asset is cash that he has withdrawn for personal use, you credit cash. If it is money from the bank account that he has taken out or withdrawn for personal use, you will credit the bank account. And if it is inventory that he has taken out, representing inventory will always be purchases. You will credit your purchases account to show a decrease in the asset, or if you look at purchases as expenses, to show the decrease in expenses, credits. So that will bring us to the activity. We're going back in terms of the pages to early activities. And this has to do with double entry, except that you're not really going to see any income or expenses, because they're dealing just with the balance sheet items. The balance sheet items would be your capital, asset, and your liabilities, right? So your assets, liabilities, and capital are your balance sheet items. So what you will see, they always give you an example. These are past paper questions. You have to be able to learn how to interpret what they're asking you. And they usually give you an example to show you so that you can figure out. So looking at transaction 1, what they would have done, what you are going to do is just like what we have been doing all the time. Identify the 2 items. So Mr. Williams invested. It's his business. That means he's the owner. Invested, that means that is capital. That is why they have capital here. And what did he invest? He invested cash. And that is why, so the 2 accounts that are affected, the 2 balance sheet items that are affected would be cash and capital. Did they increase or decrease? If they increase, you put it in this column. If they decrease, you put it in the decrease column. That is it, right? Since both of them increased, you're going to put it in the increased column. I just want something extra from you, and that will be, since we have done debit and credit, you will state whether it was debited or credited. Just put it next to it. So since cash, which is an asset, increased, it's debited. See, I have my little note here so you can see. Since capital is capital increased as well, because you have it under the increased column, it's credited. So you will have your debit and your credit. And like all the transactions that we have done, for each one, you're supposed to see debit and credit. Here's another thing that I did not mention before. It must be equal. So your debits must be equal to your credits. So you're debiting 5,000. We are not asking for the amounts right now. Great, but just pointing out, if you debit cash 5,000, you're crediting capital 5,000. They must be equal. Reason why I'm saying that too is because for number 5, you are going to end up with, here's a hint, 3 items. So 3 balance sheet items. And for that one, if you can, I would like you to put the figures for it. So for the 3 items, and then you would see whether your debits and your credits, which 3 accounts, at least 1 must be a debit, at least 1 must be a credit, and the 3rd one, which I am hinting, there is a 3rd one for this transaction, would be either debit or credit. Okay, so I'll be very interested to see your answers for number 5, as in to record the entire transaction. Very interested. At least try it. If you get it wrong, you got it wrong, but I just want you to make the attempt for it, okay? So please try that one. Hint, it's the only one that has 3 items. All the rest has the 2, 1 debit, 1 credit. Okay. Still on the same activity at the bottom, much easier. This one, you identify just like all the others, but they asked you for different information. So you identify rent and you identify check, which is bank. But they only asked you in terms of the category. So it's asset, liability, income, capital, expense. For number 1, rent was affected. What is rent? It's an expense. Expenses always increase. Check, which is bank, was also affected. That is an asset. Did it increase or decrease? It decreased because we paid rent. So that means we decreased in terms of the amount of money we spent. We spent money, so we decreased. So that is why they have decrease under asset. So notice 2 items. You have your decrease, asset, increase, expenses. All right, so that's all you have to. For each of them, you're going to have something written under only 2 of the categories. So I do not want to see, for example, number 2, you have something under assets, something under liability, something under income, something under capital, and something under expenses. No, you're only supposed to, for each transaction, have increase or decrease under 2 of the categories. So you're going to identify, like you did here, rent, check. Rent is an expense which increased, so you put something underneath expense, which is increase. Check, bank is an asset, so you write under asset what happened to the asset. It decreased, so that is why you write decrease. That's it. You go and do the same thing for number 2, identify, and then you put increase or decrease under the categories for the accounts that you identify. So once again, we have there rent, expense, check, asset, and you have put it under. So the next transaction that we have, or activity that we have, will be 2.6. It's the same thing again, but they just ask for different information. You're just going to identify the 2 accounts, and then depending on the accounts, like for example, owner invested would be capital, so they have capital, and whenever there's an investment, as it's an increase. This one they're asking for the amounts, so increase by $7,000. The next account that was affected is bank account. Bank is an asset, so you go to asset column, and did it increase? Yes, it increased. How much did it increase by? $7,000. Increase 7,000, increase 7,000. So you go to the next one, you identify accounts payable, personal savings. What is personal savings? That is drawings or investment. Did he increase his capital or did he decrease his capital? I would say that this one is a very interesting. So this activity is very interesting. Just try it in pencil. I'll be very interested to see what your answers are. You see personal savings would be some form of capital, whether it's an increase or it's a decrease. If it's an increase, it will be capital. If it's a decrease in capital, still under capital, but it will be called decrease in capital, which we know is drawings. Okay? So that is what you will do, and whether your accounts payable did increase or not, accounts payable is a liability, whether that is the correct one that you're going to put here, if it increased or it decreased. Okay, so that is for this transaction. This one is kind of like the one that we had done before. I would like once again for you just to add debit and credit, just like I showed you for 2.15. That's just the additional requirement that is not in this, because these are past paper questions. They didn't ask you for that, but I am asking you for it in terms of a form of practice. So please, you just put the debit or credit. For example, these are the transactions that they are talking about, but this time they are asking you for the actual accounts. So capital account, bank account, which up here you just put under assets and the capital. So you have the two accounts. You have both of them increased as an asset, bank increasing as a debit, as capital increasing as a credit. So I just want you to put debit and credit next to it. And you go on to the next one and you do the same thing where you're actually just identifying the accounts this time rather than the categories. And then the last one, so I actually did show it here for you. So debit and credit, nice. The last one, this one is a nice challenging one, and that's why I put a little animation for you, you know, lighten up the mood and stuff like that for you. This one, I'm not going to explain. This was an exam question. Once again, what I want you to do is I want you to interpret what they are asking you for, because in an exam, you're not going to have the teacher there to explain it to you. That's one. Two, some people are under the impression that CXC will ask the question the same way each time. So you practice it one way and you assume that they're just going to come in the exam and give you exactly the same. That is not really testing your understanding. And your exams are all broken up into different components in terms of knowledge, interpretation, and I think it's analysis, right? So you need to be able to interpret these things and not just practice something and then give them back exactly how, you know, that is not how it works in terms of their assessment of you. Otherwise, the grade would not be that valuable. Okay, your qualifications will not be that valuable. So I'm going to post these activities along with this video, and hopefully everything will be clearer to you and you're going to have this due. Okay, so that's it for this lesson. Enjoy your weekend.